So, as I was introduced, I'm giving a presentation on Australian mining productivity. Now, for some, this might be a bit of a technical presentation. I've tried not to make it technical. And some of you may not be interested in mining, but I think you probably will be by the end of the presentation. At least I sincerely hope so, given the importance of mining to Australia. So before I begin, let me just thank two co-authors of this work, Professor Kali Rajan, who's at the ANU at the Crawford School, and Dr. Arif Saeed, who's at the Bureau of Resources and Energy Economics. And so the actual report, this is a presentation, but the actual report will be coming out on Friday. So we've had a couple of technical glitches on the equations, but it will be out on Friday, and you'll be able to download it from the BRE website. So overview, I'm going to briefly talk about the importance of productivity. And I'm sure that's already been mentioned this morning. It'll be mentioned, I'm no doubt, tomorrow afternoon when Dr. Stephen Kennedy gives his presentation, and they'll have a special session on productivity. I'm going to talk about Australian mining, and that's where I hope will convince you that Australian mining is very important, even if you're not in the mining industry. Then I want to talk about mining productivity trends, and these trends are worrying, and they have been a matter of considerable discussion within government and outside of government. And then I'm going to talk about some measurements that we've done at BRE, building on work that's been done by the Productivity Commission and others, but we've extended it and developed it further. And then I'm going to give you some potential insights that come from that and some conclusions. You know, what do we do? Because this session coming up is about government and insights, uncertainty, and all those sorts of things that Bob Cotton will facilitate. But obviously the issue is, what does this imply? What do we do? And I'll try and give you some insight about that as well. So I've given a quote here, not mine. It comes from whatever it is, 20 years ago, in a famous textbook in economics. But just wants to emphasize to you that productivity is not just some arcane issue that economists deal with. And it's not just about economics. It's about society, about what we can do and how we can do more with less, so to speak. And so it affects a whole range of factors for us. And they mentioned just a few here: education, healthcare, et cetera, et cetera. So I just want to keep that in perspective, because take the helicopter view first, I think, and then we can climb down into the detail of productivity. But I think you need to keep that in mind. It's a key fundamental issue for all of us, all Australians and Americans, our American friends, in terms of ensuring that we have good standard of living, increasing standard of living, and good environmental as well as other social outcomes. So this chart covers a lot of material, so I hopefully will do it justice. So it captures three pieces of key information. There's the so-called 3 Ps that the Australian Treasury have come up with, but others have also used it. So it says what affects growth in terms of our economy, and population is clearly an important issue. Participation, that's labour force participation. How many people in the workforce, how many people in the adult population are in fact working? And then the third component, which is what I'm focusing in on, is productivity. And then within those 3 categories, you've got these 2 sets of numbers. And the first set in the light blue is those numbers in the 1992 to 2002 period. And then the second set in the dark blue is the 2002 to 2012 numbers. And if you look at them at population, population's growing. We actually have a fast-growing population in Australia relative to OECD countries. Participation rates up, population up in the context of the overall size of the economy. But the anomaly here is productivity, and productivity is down, at least over that measured period of 2002, 2012, for the economy as a whole. And then you look in that box over there, income, well, you see really no impact on income relative to the 2 decades, except there's something going on here. If our productivity is down, population's up a little bit, participation up a little bit, what's going on? Well, the factor that's going on is on the far right there, and that's our terms of trade. I think just about any country in the world would have loved to have our terms of trade increase over the previous decade, up until 2011. And that's an 86% increase in terms of trade. And I'm going to talk to you about that terms of trade, because that's allowed us to grow our incomes here in Australia and grow them substantially. But unfortunately for us, all things come to an end in the context of growth in terms of trade. And the growth in terms of trade, at least from my Bureau's perspective, is not expected to increase. So let's move. Okay. Okay, so what does this mean for government? Well, in 2012-13 financial year, you see the terms of trade maintain or decline, and there's going to be a debate about what that is. There's not a lot we can do about it, okay? So the terms of trade are going to be set by other countries, and we'll just have to pretty much accept it. So whether it stays the same or goes down, our projection is it's going to go down, and the Australian Treasury projection is it's going to go down. How fast, that's the billion-dollar question. On the issue of productivity growth, in the short run, perhaps there's not a lot we can do in the immediate term, but over the medium to long term, there's a lot of things that we can do in terms of affecting productivity growth. And so those two lines that sort of where we're going with productivity growth is really the issue in terms of what we do as an economy, what we do within government, what we do outside of government. It's not just a government issue. This is a whole of economy issue. And that's where I think I'm trying to emphasize the importance of productivity, where to Australia, and mining, of course, is going to be part of that story. So Australian mining, to get a sense of what's happening in productivity and the story of the narrative I'm about to give you, you have to understand what's been going on in Australian mining. And for some Australians in this room who I know this story very well, my apologies, but I know for some of you who are not, and certainly from overseas, from my friends in Boston, they will not necessarily know the story. And so I'm going to go through it in some detail because it really does have implications in terms of what's happening to productivity. So here's a first of several figures that I'm going to give you. And this looks at gross value added, okay, which is a way of measuring up the different components of an economy as a proportion of the GDP, okay, gross domestic product. And you can see that it's more or less flatlining up until about that period of 2004, 5, or 6, okay, and things start to take off in terms of gross value added. That's the upper curve, and starts to go up, and go up substantially. Now it's running now at around 10%, okay? So it's pretty much doubled its share of GDP in about a decade. That's a fundamental shift in an economy, doubling your share in a decade. So there's something going on, and I'll go through the details. The other aspect to it, it's not quite the same in terms of when it starts to kick up, not quite the same, but nevertheless you see another big kick up there in terms of gross fixed capital formation, which is what the mining industry has been doing in terms of making investments in terms of mining. And there again, that's a fundamental shift as well to the proportion in the economy, such that mining capital formation now covers over half the capital formation in the country as a whole, which is a fundamental shift. So here, that's the share that I was talking about. What about employment? So that's the capital story. Capital has been going up and going up substantially in the mining sector. And that's the employment story. So employment more or less flatlining up until the early 2000s, and then starts to kick up. Now running around 250,000 in terms of direct employment. There would be obviously more people employed indirectly in terms of the mining sector. And then here's the story from the export side. So you look at 1990, mining has always been important in Australia, so let's be clear about it. It didn't just happen in the last 10 years. Okay, so we had a gold rush here in the 1850s, in Victoria primarily, but not just in Victoria. That led to a fundamental shift in our economy. That was the sort of the big kickoff for us in terms of our mining boom. And that led to a huge influx in terms of immigration and our population. We've had subsequent booms. We've had a wool boom, and we've had various other things along the way. But this is another boom. This is another boom. This is another one of those big ones. And it kicks off at around the early 2000s, depending where you want to start it. And you can see there that's now accounts for 60% of our export values out of Australia, out of the mining sector. So it's very important. And then you can see what those numbers translate into. We get a bit shocked by numbers. I certainly, even in my current role, I get shocked by how large some of these numbers are. But if you add those two numbers up, one is in minerals, okay, so that's like the iron ore that we export, and the other one is energy, and that would include coal and liquefied natural gas. You add them up, it comes to around $200 billion. That's on an annual basis. So that's a lot, okay, when you're in a 1,400 billion economy. And then now I'm starting to tease out. So first of all, you know that productivity is important. Now I've explained to you that mining is important in Australia. And now you also know that something's happened in the last decade. Something really big has happened. And I'm going to go through and tell you what the big thing was. And the big thing was a demand shock, primarily in China, but not exclusively in China. That demand shock led to a substantial, very substantial rise in prices. You look at that as an index of 100 there, which is in 2000, March 2000. You can see there are some very large increases in terms of the metals that we export out of Australia. You can also see there's variability there, and you can also see a substantial dip, and you'll know that substantial dip is the global financial crisis. And so there was a big fall off in prices in the aftermath of the GFC post-September 2008. But you can also see that prices rose and peaked, not for all, but peaked more or less around 2011. And you can see it, this is smooth over that last decade. You can see it for iron ore. Why iron ore is important? Well, we export about $60 billion worth of iron ore. We're the world's largest exporter of iron ore by far. It's big in all sorts of ways. Coal is also an important export from Australia. And you can see the similar sorts of trends, although they've been smoothed in terms of prices. Prices are still at historic highs in the context of where they were a decade ago, but they are down, and they're down from 2011. And this gets back to the story. Okay, so if you look at that second figure I provided to you, or the first figure I provided to you, what happened to incomes over the past decade? Well, incomes grew substantially, about 50% over the past decade. That's a wonderful outcome for Australians, but that was essentially due to terms of trade effect, which is due to these much higher prices. So if the high prices are no longer, they're high, they're still high, but if they're no longer going up, and they're not, then that tells us that if we want further income growth, it's got to come from someplace else. It's not going to come from growing prices. It's going to have to grow from something else. So that something else, I would suggest and contend, is productivity. So let's look at mining productivity trends. Lots of information here. I'll try and condense it into a framework that we can just follow through. So you'll see a lot of sectors. We can divide up the market economy into different sectors, and mining is an important sector, but it's not the only sector. But you can now look at those different sectors, and you can see mining is the second one along. That's that column, mining just after agriculture. And you can look here in terms of what's called multi-factor productivity. So that's what's happening to a growth in outputs after we've accounted for the changes in capital and labor. It's all the other factors that we haven't accounted for. And if you look at that, you can see that there's been a trend downwards in terms of our productivity. So if you look at the red or the ochre colored and then the amber color, so that's the ochre color is the 85, 86, and then the 90s, and then the last one is the gray, which is the most recent period. You can see there's a decline in most of the sectors, but not all, but most of the sectors. And you also see in the mining sector, it's the biggest decline of all. So mining is not only important, but in a productivity sense, the biggest change in productivity has been in the mining sector. And we need to understand why that is and explain it and understand it, because if prices aren't going up anymore overall, how are we going to grow our income, and particularly in the mining sector? So obviously productivity is important from that perspective, as well as, of course, the overall economy. So here's a comparison as well. So we not only should compare ourselves across sectors within the economy, we should try and see what's going on internationally. So here's a study, not a brief study, done by others, but looking between comparisons Canada, the US, and Australia. Canada and Australia are quite useful comparisons. Similar sized economy. Canada, of course, is a bigger economy, but they do have similar sets of issues in their economies. And you can see that there's a change there in productivity growth, a decline in all of those countries, but the biggest decline is in Australia. Okay, so there again, the performance hasn't been good in other countries in the last 2 decades relative to where they were. So last decade vis-a-vis the previous decade before that. The performance in Australia is marginally or substantially worse, depending how you define it. So there again, it tells us we've got a set of issues here. And then here is the actual numbers for Australia in terms of the unadjusted multi-factor productivity. So I'm going to talk to you what I mean by adjusted and unadjusted. But these are unadjusted numbers that come from the Australian Bureau of Statistics. And then there are single factor productivity measures as well, both capital and labour, the two main factors of production. And you can see that productivity is floating along in the 1990s. There seems to be a bit of a pickup just at the end of that period of time. And then as the boom gets underway, productivity slides. So I think we can tell a story that something's going on here related to the mining boom and productivity. And I'm getting to that story. And so to take that to the next step and see what actually is going on, we need to measure productivity properly. And we need to measure it properly in particular, of course, in the mining sector. We need to measure it properly everywhere, but particularly in the mining sector, in the sense that the mining sector is different. Okay, so why is the mining sector different? Well, because the mining sector's output, of course, is taken out of the ground. Now, if the resources that are available to us remain the same, the quality is the same, and productivity declines, and it's exactly the same war today as it was in 2000, as it was in 1990, as it was in 1950, as it was in 1900, then we could attribute that decline in productivity to something going on in terms of either management or something else in the economy as a whole. But that's not the case, okay? Okay, there is a secular decline that's not just in Australia, it's across the globe, and it happens at different rates for different commodities, of what we would call resource depletion or decline in yields. So in other words, the amount that we can extract of whatever the ore body is out of the ground is declining because we got to the best bit first, and we're getting to the less bit, the less lower quality stuff as we progress through time. So we've got to account for that to have a proper understanding of what's happening to productivity in the mining sector. So the ABS doesn't do that. We've done that. And so one of the key ways to do that is to do this adjustment. And we've done an adjustment, and that's the depletion numbers that we've got there. And they jump around a bit. We use energy, amount of energy petajoules that are being used in the mining sector, and we correct to the initial base year. And that is a proxy for what's going on in terms of the reduction in quality and depletion. And so once you take that into account and you see there's a secular trend downwards there over that period of time, you're going to therefore have an impact on how you measure productivity. The adjusted numbers accounting for depletion will therefore be higher than the unadjusted numbers if you didn't account for that depletion. Not a big surprise, but quantifying that and going through that analysis is a lot of legwork and a lot of detail, and it's important. The second aspect that's not unique to mining, so what I went through, resource depletion, is unique, but what is not unique, but is true for a couple of other sectors, in particular in Australia and elsewhere, is the capital used to generate the output. So mining is an extremely capital-intensive industry, and so when you make your investments in terms of capital, you are not going to get your output at the same time you make your investment. And sometimes it can be several years after you make your investments before you get the output. So that's an output lag effect. It also exists in the electricity, gas, water, and waste services sector in Australia, and you find a similar sort of outcome there as well. So you have to account for that in terms of using lags. So the importance of that is to say, well, although productivity may seem have declined substantially now, as the output comes through from that investment, we would expect that productivity to go up. So if you took the long-term view, you'd then make that adjustment. So it wouldn't look so bad now, and it would be looking a little bit better into the future. So once you do that, you can start to get a handle on what's actually happened in terms of multi-factor productivity. So if you take the unadjusted numbers, those are coming out of Australian Bureau of Statistics over the entire period. Your unadjusted numbers about minus 0.65. That is much, much worse than that in the last decade, but that's over the entire period. You can do a capital adjustment, which is what we've done. And then you can do an output adjustment. That's for that resource depletion. And then you get, bam, you get 2.5% increase in multi-factor productivity over that entire period compared to a decline of 0.65%. I have to say, though, that the productivity, even when you make the adjustments, adjusted multi-factor productivity growth is less in the past decade than it was in the 1990s. So there's still an issue there in terms of a decline in productivity growth, but nevertheless, it's nowhere near the issue if you take the unadjusted numbers. And so you can do some comparisons, and here are the comparisons between the unadjusted and the adjusted, and for the two different periods. Typically, when you look at productivity growth, using 1 year or even 2 years numbers is really not appropriate. You really have to take a long-term view, and so we've split it up into 2 decades. Ideally, you should do it from peak to peak or trough to trough over a business cycle, except we've been blessed with 21 years of economic growth in Australia. so if you wanted to take the actual business cycle as a whole, it would be a bit tricky to make comparisons in that sense. So we can split it over 2 decades. And then there's another way. We can take those numbers that we've generated in terms of productivity change over the periods, and this is over the last 20 years, from the early 90s to 2010, and we can see to what extent productivity growth has been assisted by technical progress, which is TP, TE, technical efficiency, and SC, which is a scale effect. And so according to the numbers that we've done and the analysis we've done, technical efficiency has certainly been a major factor. So in other words, if you think there's a frontier of best practice, then the mining industry has been moving closer to that best practice. If you think of technical progress is like moving that frontier upwards. Okay, so certainly technical efficiency, we've been moving up to the frontier, and scale means the scale of the operations have been getting bigger. In fact, they've been getting a lot bigger, and that's also contributed to increased productivity. The technical progress, we don't see a statistically positive trend there in technical progress over the data that we have. So I'm going to conclude now. Just to finish in the time available to me, let's just go through it. So first key point, well, let me just stop. First key point, of course, is productivity matters. The second key point is that mining is really important in Australia. And then the third key point, which is where I'm getting here, is that we've got an issue of productivity in the mining sector. And so if you look over those rates, unadjusted, we've got a decline in productivity. If you take that almost 30-year period, but it's a much, much bigger decline if you just take the last decade. Then that's what we've done in this analysis, which as I said will be released on Friday. We can then remove the influence of the capital issues as well as resource depletion, and we get a multi-factor productivity growing at 2.5% over that period of time. But the growth is still less than the last decade vis-a-vis the 90s, and I can talk about that after my presentation, if you wish. So where does this put us? Well, I'm saying productivity matters. Productivity growth in the mining sector certainly has, after we've made the adjustment, has grown. But there are issues that we need to focus in on. And one of the things that we need to focus in on is why this has been what it has been. So in other words, why do we have this depletion effect coming in so strongly over the past decade? And you can see it's a very big impact over the previous decade. And one of the insights I think we can provide here is that, as we would call it, endogenous resource depletion. So if you think of resource depletion as a factor that the ore in the ground is where it is, and you just pull it out, you take the top bit and you just keep on going down, that's really exogenous resource depletion. You really have no choice, and you just take out whatever you can as you go through the process. But endogenous resource depletion is where, when you have much higher prices, you actually seek out the ore bodies that are available to you that have the lower levels of ore, because you can afford to extract them at those higher prices. And that, I think, has been part of the explanation. And so where does this take us? So I'll just leave on this point. Where does this take us? Well, my bureau, has projections that will be coming out on Wednesday morning. I can certainly talk about our projections from December of last year, but they're not too different. And we project that there'll be very substantial volume increases from the mining sector, both production and exports, very substantial volume increases. So that would suggest that as we move forward over the next 5 years, not over the next 1 or 2, but over the next 5 years, that productivity performance in the mining sector should pick up. That would be our expectation. And that also would be influenced by, of course, what's happening to commodity prices and this notion of endogenous resource depletion. So thank you.